Welcome to The Chemical Show, the podcast where chemical means business. I'm your host, Victoria Meyer, bringing you stories and insights from leaders driving innovation and growth across the chemical industry. Each week, we explore key trends, real-world challenges, and the strategies that make an impact. Let's get started. Okay, we're going to get things going. Thank you, everyone, for joining us today for the first Chemical Show Live of 2025. I am super excited to have you guys here, and I'm very happy to have Tony Potter and Kurt Barrow from S&P Global with us today, sharing their insights on the chemical market outlook for 2025. So these guys both bring a wealth of experience in energy and chemicals and are here to share that with us today. So I'm going to stop sharing my screen. We're going to start conversing and we'll make this happen. And as you guys have questions, go ahead and put them in the chat. We will start grabbing the questions at the end, but if something comes up, please go ahead and do that. Kurt and Tony, thanks for joining me today and welcome to the Chemical Show.
Thanks for having us.
So I like to start every episode with just a little bit about you. Tell us how you got interested in energy and chemicals, and then how did you get into this wonderful world of watching markets and analyzing what's happening and advising customers? Kurt, I'm going to start with you.
Sure. Yeah. Well, Victoria, I'd like to say there was some big grand plan, and I had this big vision that I was going to be this oil analyst, right? The reality is, when I came out of university, right, with my engineering degree, Exxon had the biggest number on the job offer, right? So I came to Houston and started Exxon, and then really enjoyed my time there. Was really interested in the business side. Went and got an MBA, and then went out to I worked for consulting in a small kind of boutique consulting firm in the refining downstream space. And then that company got bought, as oftentimes happened, by then IHS, which kind of rolled up into S&P Global. So it's been a great career, not really super planned, but enjoyed my time kind of in industry on the technical side. Did a lot of consulting, and then now I run research, right, for oil, and it's just such a dynamic, interesting industry, tied into the economies and geopolitics, and there's just always so much to learn, technology and obviously energy transition, and so it's just kept my interest, and I've stayed with it.
Awesome. Love it. Tony, how about you?
Not dissimilar story. I love this job. It's been paid to study. I grew up with the chemical industry on my doorstep. My dad worked for ICI Wilton up in the northeast of England for 27 years. In fact, they built ICI Wilton in my grandmother's back garden, literally, after World War II.
Does that mean you guys made a lot of money as land barons and stuff, Tony?
No. She didn't own all that land, don't worry. I did a Chem Eng degree. I started at Exxon as well, at Fawley Refinery in the UK. I was 9 years into my career. I was a typical Exxon engineer, being a plant supervisor and a project manager and things like that. When I went to their European head office in Brussels for Exxon Chemical, and it was there I actually found out that the job I do now even exists. And I became, on behalf of Exxon, the clients of consulting companies like the old CMAI, where I eventually became a partner, and we sold CMAI to IHS in 2011. And then the journey with CMAI, IHS Market, the logo keeps changing on my business card every 2 or 3 years, but I'm more or less still doing the same job. But I've had the privilege of doing it not just in Europe, but I was 4 years in Dubai, I was 5 years in Singapore. I've had the privilege of sort of talking to C-level clients all over the world. It's fantastic.
That's great. And I think you talk about it being a global career. I think many of us in the industry, myself included, didn't realize how global my career would be before I joined the industry, and certainly have loved every bit of that.
Tony spent time in Dubai, stationed there a while, and then in Singapore. I was actually in Singapore as well. So yeah, very, very, very much so. Very interconnected, getting more connected all the time.
Absolutely. So let's talk about what's going on in the market today. How would you characterize 2024? And what are you seeing and expecting in 2025? And Kurt, let's start with you, because I know the feedstocks is really the starting point of everything.
Yeah, no, absolutely. Maybe I'll share a slide or two here, right, and help kind of talk through this. So, fundamentally, the fundamentals, right, in the oil NGL space, maybe to a lesser degree in natural gas, is that we're in an oversupply, right? Or headed into more of an oversupply, right? We're producing more oil than we need, right? So the global oil supply system is adding more to the market than right? And there's a number of reasons on demand we could talk about. China is not growing at kind of the rate we'd expected. EVs are a small part of the weak demand today. It actually has more to do with kind of vehicle fuel efficiencies. But in a general sense, right, we've got oil prices kind of moving downward, and we can come back and talk about Trump and tariffs and some of the factors that are affecting the oil price, kind of day to day, week to week. But I think the key takeaway is that we are, in our view, at least in the base case, headed on a generally downward track for Brent. If you kind of shift over a little more into the feedstock side, one of the big dynamics of the past years is just the amount of NGLs that were coming out of the U.S. supply system. And that's, part of that was coming as associated NGLs from the oil production. Some of it was coming from some of the wet gas plays and the growth in natural gas and the LNG to feed the LNG plants and so forth, right? We do think that there's a number of factors that will start to slow that. Still growth, right? And still relatively impressive growth, 200,000 or 300,000 barrels a day. But that is kind of one of the factors we see. And it's part of the longer trend, right? We'll come back and talk a little bit about. But, at a high level, because of some of the fuel economy standards in cars and trucks around the world, because we are starting to see some electrification of transport in some markets, there's a number of reasons that we do expect the oil demand globally, right, refined products in particular, and transport fuels, to start to plateau and peak. And that's going to have some real direct implications for feedstocks, right? It's going to mean that we have less NGL growth, of ethane, propane to use as feedstocks. We'll need to come back to naphtha, and we'll need to essentially get more hydrocarbons out of the crude system, out of the refining system, to supply that, to meet demand growth in chemicals that that Tony will talk about. So that's kind of in a nutshell, right? Kind of the short and long-term view, Victoria.
Yeah. So at one point, we talked about a shortage, right? That we were running out of cheap feedstock, that the Middle East wasn't going to have feedstock anymore. And of course, the US, with its really strong basis in natural gas, has been a very strong part of the feedstock chain. Do we still have those conversations? Are we running out of petrochemical feedstock?
Yeah, I'd say we're not running out. And that's a good context, right? If you go far enough back, right, we kind of thought we were running out or had those concerns. And then, as you said, the NGL supply kind of rose out of the Middle East. And then in the US, we found tight oil, right? Shale gas and tight oil. I would say we're not worried about availability of feedstocks. I think it's more about the cost and economics that will ultimately come with that, right? Because we won't have as much surplus NGLs, right? So the NGL markets are quite interesting. They're one of the few markets that we view as not so much demand pull, right? It's not the demand like you have in gasoline, right? You think about gasoline demand or ethylene, right? You think about the pull from the derivative plants, right? The NGL business is much more of a supply push business, right? They're a byproduct of natural gas and crude oil production. You're generally not drilling for NGLs. And then you kind of need to clear the market with those NGLs, right? And the clearing market is petrochemicals, right? It's the marginal market for NGLs. And so it becomes really a price signal, right? At which point you would switch that flex cracker or over the long term, change your investment profile to those feedstocks, right? And so if you take our view, right, that we're not going to have as much NGLs, then effectively you just need to go back to the refining system and get more feedstocks. Now, but they may cost you a little more, right? So the naphtha crack may be a little wider. Ultimately, we may need, we think we will go into deeper conversion, like different crude oil, the chemical technologies.
Yeah. So I know this week I was reading that LyondellBasell is starting to shut down the Houston refinery. And of course, that's been something that's been coming for a long time. how does you see this affecting
Sure.
the market availability?
Yeah, yeah, it's interesting, right? Broader demand trends that's on the chart here, right? We will see rationalization. We've seen rationalization for a long time, right? We used to have whatever the number was, twice as many refineries in the U.S. Actually, in hindsight, the industry rationalized a little more than we maybe should have because when demand came roaring back in the Russian invasion of Ukraine and the high natural gas price kind of exacerbated that.
Got it. All right. And as you guys might have noticed, my internet has decided to be a little unstable, but we are going to push through with this. So, Tony, let's talk about chemical markets. And when you see, when we talk about the feedstock picture, how do we start taking this into chemicals?
Yeah, so I mean, just a message on feedstocks. Wherever the industry produces advantage price ethane, it's going to get cracked eventually. The US isn't going to run out of ethane anytime soon. The Saudis have a gas initiative, and we're hearing numbers that there'll be sufficient incremental ethane for another 6 million tons of ethylene, and that's before they get onto all of their crude oil to chemicals complexes that they'd like to build at some point in the future. But generally, the industry is oversupplied. It's built its way into a problem in most value chains. What I show here is sort of incremental capacity in the bars for ethylene globally. The bars are the incremental capacity. The grey shaded area in the background is the incremental demand. And you can see that period starting in 2020 when the height of the bars is much higher than the height of the shaded area behind. The color coding, China is red, and you can see China has accounted for a good 50% of incremental capacity in the last few years, and so industry capacity utilization is quite poor. You go back 4 or 5 years, it was up at 90%, and that's effectively full on a nameplate basis, right? Every year the industry shuts 4% down for planned maintenance, turnarounds, loses another 4% to unplanned outages. When you're talking about 90% capacity utilization, the industry's full. And you go back pre-2020, prices and margins were very good for the industry. Last year, industry capacity utilization bottomed out around 80%. That's the black line on this, and you can see it's a long, slow haul up to the sort of mid to high 80s where the industry, the naphtha cracking industry, can leverage margins. Generally, profitability is poor. The industry is talking about rationalization. That process has started, mainly in Europe, but we'll get some closures in Japan. We'll probably get some closures in Korea this cycle for the first time. The place that's actually very disciplined about closing all small capacity down is China. Often goes unnoticed, but they build 1.5, 2 million tons of new capacity, and they quietly shut 150, 200,000 ton old cracker, which is exactly what they should do. But I've seen a few of these cycles now, and there's never enough rationalization to sort of jumpstart this into a sort of profitable area of industry utilization. I'd say in the ideal world, for the producers, they'd shut down 20 million tons of capacity, and that black line would take a step change upwards, and all would be sweetness and light. And that's not going to happen. Everyone wants someone else to go first. We can envisage, 5 or 6 million tons of rationalization this cycle, and the industry's into that. Not all doom and gloom. So, for your US listeners, it's the naphtha cracking industry that's challenged. That's the high cost end. If we maybe go forward a couple of slides, we publish this every week. So this is a sort of spot variable cost of production for ethylene from various feedstocks. These are generic crackers. They're not any particular. So, the lowest cost production right at the moment, the bottom left is, US ethane cracking. It's as cheap as Saudi ethane cracking right now. The generic naphtha crackers prevalent in Europe and Asia, the 2 orange bars on the right-hand scale. It's that right-hand end of the chart that sets the general level of petrochemical and polymer pricing. So, all of the things being equal, the oil price moves up and down, so does naphtha, so does ethylene, polyethylene, benzene, styrene, you name it. But what you can see is, US ethane-based producer has got a $600-700 a ton cost of production advantage relative to a typical naphtha cracker right now. So, if you've got advantage price feedstock, money is being made in some parts of the world. And then there are other little niches that are doing quite well. When we talk about an 80% capacity utilization, actually the high cost end of the industry, the naphtha cracking industry, is disproportionately pulled back more. And that actually creates shortages of core products. And the obvious one at the moment is C4s. So there's a shortage of crude C4 molecules, and butadiene margins are doing great as a result of that. But those are niches.
Hey,
Back
Tony,
up
when
a
we look at
slide,
this
please.
slide real quick, is the yellow orange bars of European naphtha and Asian naphtha, is that to indicate that that's where the price is being set? If we think about a traditional supply demand curve, is that
Exactly.
our price setters?
Yeah, exactly. It's the requirement of the high cost producer to cover their cost of production that more or less sets the price. If you go over to this one, so this is, basket of base chemicals, and this is the industry nameplate capacity utilization. And the top blue line's ethylene. I talked about that. It went from 90 to down to 80. The purple line's paraxylene. That was also up at 90% a few years ago, and that bottomed out last year at around 70%. But actually paraxylene's been doing okay, right? And so industry capacity utilization or nameplate capacity utilization isn't the full story. You've got to get it where the effective utilization is, where the pinch points are. And in the case of aromatics, the gasoline industry has been supporting it. So, high octane values, and all the money has been made in making the toluene and the xylene for its octane value. If you had to buy mixed xylenes on the market, there was no extraction margin to produce paraxylene or orthoxylene. That's maintained some margin in the aromatics industry. Kurt's already mentioned gasoline balances probably lengthening as a result of huge refineries like the Dangote refinery. As that premium on octane comes off, then paraxylene will begin to experience the full impact of that 70-75%.
Okay. And how does this play out when we go further down the value chain? Obviously, because these are kind of the big building blocks. Where do you see it taking into more differentiated products or more specialty products?
We define a specialty as something that's sold on the basis of its performance rather than its cost of production. So it can cover a multitude of things, but what's a specialty depends where you sit in the value chain. I talked to some Middle East producers and they talk about specialties, and really they're going to produce intermediates. That's a mixed bag, depending on the industry and the overbuild. But if you look at the financial performances, of the Evonik's and the Clariants and, the big specialty chemicals producers, they've suffered as well, but we expect that to start picking up.
How about the wonderful world of plastics, right? Because obviously a big part of the ethylene value chain goes into polyethylene and then, polypropylene and all the other
Well, most
polys.
most of this ends up in plastic one way or another. Ethylene
Yeah.
into polyethylene, PVC, propylene, polypropylene, PET from paraxylene, benzene into the styrenics. So most of it actually ends up in polymers one way or another. And the polymer plants get built on the same cycle as the monomer plants. So, you build an ethylene plant, you build the polyethylene and the polypropylene with it. So the curves look more or less the same, and are equally as challenged.
Yeah.
It can be a bit misleading to talk about ethylene profitability, on its own, because you've got to look at the integrated economics into the derivative. But I assure you, the polyethylene curve looks the same as the ethylene curve.
So global chemical markets are imbalanced in a way that I've never seen. And we've gone through a few cycles. You've already referenced how overbuilt it is. But if we think about just the regional dynamics are shifting quite a bit, right? Suffolk's Director General Marco Mensink recently warned that the European chemical industry is at a breaking point with over 11 million tons of capacity being shut down over the past couple of years, or at least announced. We're seeing significant overbuild in China, as well as pretty low demand growth. And then we've got North America seems fairly strong. But how do you see companies, both global companies and regional chemical companies, navigating this? Because I'm certain this is a conversation you're having with leaders all the time.
Yeah, I mean, if you look at, let's take Europe as an example. I'm sat in Germany, where I live, and Europe's got probably the oldest cracker stock in the world, right? Plants are 40 and 50 years old. Some of them are even slightly older than that. They're old and they're small. There are a dozen at least old small crackers that have got a capacity of 400,000 tons or less. When a world scale cracker, people are building 1.5, 2 million ton crackers these days. And the thing is, they dotted around the coast of Europe. They're not connected to anything other than their own derivative plants. And so if you want to take a cracker shutdown decision, you've got to take a site shutdown decision. And over the cycle, they've tended to be cash positive, right? These things are fully depreciated. As long as they don't need a big capital injection, there's cash to be made. What's different in this cycle is that as players are faced with the choice to inject capital to decarbonize, right, that's probably going to tip some of them into shutdown decisions. And it's probably right that old small capacity shuts down in favor of, newer, bigger, more efficient capacity. That's the way markets work. But the exit costs are high in Europe, site remediation costs. You got the whole political factor. No EU politician worth their salt wants to shut a chemical complex down on their soil. France, I'm thinking France, Spain, Italy, where some of these small crackers are. And the politics is always about employment. And that's the issue. And so it's a slow process. Ironically, as Europe talks about decarbonisation and about things like CBAM, carbon border adjustment mechanisms, that actually could create, effectively a tariff around Europe that prolongs the life of old small crackers, law of unintended circumstances. So we'll see how that pans out. But Europe certainly started that journey of shutdowns. I mean, you talked about the players regionally. Many of the players in Europe are global players, right? I mean, Exxon are shutting down a cracker in France. SABIC are shutting down a cracker in the Netherlands. So they have global supply strategies anyway. I'm not expecting Exxon to sell less polymer in Europe as a result of shutting down the Gravenchon cracker. The issue is where it comes from.
Fair enough. We started talking, and Kurt referenced a little bit, politics and geopolitics and the influence, right? So the U.S. has just brought in a new president, Donald Trump, and administration in the U.S., who's already making a lot of bold statements about trade and tariffs. We've seen presidential changes in a lot of other countries, leadership changes across the globe, both Latin America, Europe, right? I mean, France had 2 or 3 snap elections last year. We're starting to see it in Asia as well. So, I know you guys are tracking and monitoring these political shifts. What influence do you see this having on the chemical industry, either, this year or next year? I know nothing is immediate, but how do you see this playing out?
Yes, you're right. Everybody's trying to monitor and see, what exactly this means, right? I think you laid it out well, right? I think the Trump administration is the one everybody's looking at, but there's been a number of shifts of different administrations around the globe, right? And I think, what does this mean for energy? What does it mean for policy? What's this mean for trade and tariffs when we're in a very, globally interconnected market for, for oil and for chemicals, right? And I think the other thing, right, that we're thinking about, right, is okay, what are not just the actions, but what are the reactions, right? Because Trump puts tariffs on Colombia, right? What's Colombia do? How do they react? And then, you've got some of the bigger players that are kind of in the middle, like India, Brazil, that want to keep good relations with the West and with China and with Russia, perhaps. And so, how does all that play out? I think, if you get down into kind of some of the energy policies that Trump has announced on the campaign trail, signed some executive orders on, some of those are quite impactful and immediate. Things like reduction of subsidies of electric vehicles, right? That's going to slow the sale of electric vehicles in the U.S., particularly for some of the big 3 automotive manufacturers, maybe a bit less for Tesla and so forth. But things like oil production, the executive in the White House doesn't really have much to do with oil production in the U.S. They will relax some of the regulations, some of the environmental rules, shelve the methane rule, but most of the drilling and most of the growth of oil production is on state and private lands, and most of the decisions that the executives are making on how much to drill is really being informed more by their shareholders' desire and the price of oil, right? And so that, in some ways, the administration could actually lower the price of oil and actually reduce some of the drilling activity potentially.
And I think for chemicals, again, it depends on the responses from the other countries, right? So, I mean, the US exports a lot of polymers to China. If he slaps tariffs on plastic, right? If China were to do the same, what tends to happen with tariffs is the world rebalances, it just reshapes. So a lot of plastic goes from the US Gulf Coast to China, and then it comes back to the US as finished goods, semi-finished goods, right? Maybe via Mexico, maybe via Vietnam, right? All sorts of games can be played. But let's pretend, China slaps a 25% tariff on US plastics. All that would happen is we'd probably see more US exports to places like Europe, and then the slack into China would be taken up by the Middle East. So the world would reshape to tariffs, right? The bigger concern is, what does inflation do to demand? And does that depress the industry? Tariffs are going to lead to inflation, which potentially could lead to low growth, right? I mean, tariffs, the US could be shooting themselves in the foot here. And, the US is a big component of global demand. That becomes an issue as well.
Time will tell. So let's talk about sustainability and decarbonization. Any conversation in chemicals would be remiss without that. And that certainly also ties in politically because we're seeing a bit of a waning of interest or support for some of the commitments that were placed at the beginning of the decade or even prior to then. I mean, and I think in certain places, we say, well, we're here, right? So there's significant investments in carbon capture. There's been a lot of ongoing efficiency in carbon management. There's a lot of green chemicals, circularity at play. And yet, in many ways, we are still in our infancy as it relates to sustainability and decarbonization. And we've got this whole big question of who's going to pay for it, because sometimes it seems to only make sense when there's subsidies, right? If we think about electric vehicles, for instance, and the knock-on effect it has. But I feel like we're in a bit of the pendulum is swinging. How's that? How do you guys see this playing out when you talk about sustainability, decarbonization across energy and chemicals?
Yeah, I think there's a lot of very worthy projects out there that together do not add up to enough. Countries will miss targets. I'm sort of more interested in whether individual company pledges meet targets, and I think we're seeing evidence that 2030 milestones are slipping to 2035. Of course, the big thing in the chemical industry is the circularity of polymers, right? If you could perfectly recycle every pound of polymer, you wouldn't need to make much virgin polymer. At the moment, we estimate, probably about 8% of polyolefins are mechanically recycled globally. Even if you assume a doubling and almost tripling over the next years in those volumes, is what we sort of expect, it's not enough to blunt the underlying growth demand for virgin polymer, right? So it takes the edge off it a little bit, but virgin polymer demand keeps growing. And that's an important message for the chemical industry. It says that the chemical industry still needs to invest to grow. So you've heard Kurt talk about, the oil complex peaking, and then in 2050, there's 12.5 million barrels a day of less of oil demand. The chemical industry keeps growing. And even if you assume the absolute massive increase in mechanical recycling, the world's still going to need to build another 100 million tons of ethylene between 2030 and 2050, at least. And that's a very positive message for the industry in terms of, the need to invest and decarbonize. The other thing that's going on is the advanced or the chemical recycling, where you turn plastic into something that looks like chemical feedstock. That doesn't get rid of the need to build the cracker to process that, right? So it impacts the feedstock balance. It's a very slow process, and there are some parts of the world where it's hardly developed at all. The only plastic that with substantially higher recycle rates is PET bottle resin, and that's fairly obvious. The average consumer can identify it, they can separate it, so you can collect it very, very easily. And by the way, a lot of it gets downcycled into polyester fiber. Right. Only about 12% of bottles end up as new bottles, but the total numbers, when you look at what gets reused as polyester, that's more like 60%. And then you look at how the chemicals are made, right? The decarbonization of the plants themselves, that is a very slow process. There are test e-furnaces, electric furnaces, but no one's built a new cracker yet with e-furnaces. Right. All these new crackers in China have conventional furnaces. So when you add it all up, you can't conceive of the chemical industry getting to net zero without substantial carbon capture, at the end of the pipe.
Yeah, I think on the energy side, right, very similar, right? I think policy matters, but so do economics, right? I think we're at that point where companies, right, are trying to figure out where the economics are. I mean, there's been cost inflation in the supply chain, right? So some of this kit is going to cost more than maybe we thought a few years ago. And then we go back to Trump, right? I mean, the IRA, right? The Inflation Reduction Act was the 800-pound gorilla, and where a lot of companies were putting a lot of attention, right? Because there were some really big tax credits there that looked quite attractive. But now that's all been put on hold. Our own view is that a good portion of that will continue on. Maybe it gets adjusted and relabeled a bit by the new administration, but that uncertainty, right, is something that companies have to struggle with. If the economics aren't there, to what degree do you rely on policy, and how much do you want to put that risk out there? I just say one other quick thing at a 50,000-foot level. If you kind of step back and look at the energy, we have not done a lot of decarbonization, kind of to Tony's point. We've done a lot of electrification. PV, solar, and wind is economic, and we see a lot of growth in that. In the West, in China, a lot of other markets in the Middle East as well. EVs also were, becoming somewhat successful in different markets. But the actual decarbonization of the molecules of carbon still in its early stages, right?
Yeah.
And you asked about who pays. I mean, ultimately,
Yeah.
the consumer, right? What's interesting is the pull from the brand owners for recycled plastics is more than the availability of right quality recyclate at the moment. And that's why recycled pellets, are trading at a premium to virgin pellets. It's got nothing to do with the cost of production of those recycled pellets. It's the Danones and the Nestles, they want to be able to print on their yogurt pot that yogurt pot is 40 or 50% recycled material. And will the consumer pay? Well, rich consumers in Europe will pay an extra penny to go green. I think the evidence from the US is even the green consumers, no, they still want it as cheap as the virgin plastic yogurt pots. So
yeah, I want it to be good but not expensive. That's the message.
Exactly.
Well, this has been great, and I know we've covered a lot. And Tony and Kurt, I really appreciate that. Of course, we can only cover so much in our 40 minutes together, and then leaving some time for questions, which I want to do. And I know that you guys are going to be covering this in depth. One, you do it all the time with clients, but then World Petrochemical Conference is coming up, and I would imagine that we're going to see some of these things in greater detail and more topics at WPC. So can one of you guys talk about that a little bit? What should we be expecting from WPC this year? And who should be attending?
Yeah, sure. Anyone who is remotely connected with the chemical industry, right? So whether it's product managers, analysts, financial analysts, producer analysts, strategic planners, anyone involved in the buying and selling of chemicals, you want to know what the industry is going to look like going forward, come and talk to us. It's the week of the 17th of March. It's the 40th anniversary. So we got some special guests who, from the industry. Scan the QR code. If you want to send Kurt or Ryan email, we can probably wangle you a discount. Or I think
yeah,
your listeners get a discount anyway.
We do
Victoria.
have a discount. I'll send it out. We've got a discount. In fact, it's long, so I can't remember, but we've got a 5% discount. So use it. save some money and let people know that you heard it from me.
The format is we have an executive conference that's a plenary with CEO level speakers and panelists. On that first day, you get the basics of our economic outlook, our oil forecast. We got people like Dan Jurgen speaking, but it's then in days 2 and 3. There's a multitude of breakout streams, some of them value chain specific, and olefins derivatives, aromatics and derivatives, a methanol ammonia stream, refining and feedstock stream. But some of them also, there's a whole day dedicated to circularity and the developments there. So, whether it's mechanical recycling, advanced recycling, looking at the technologies involved, looking at alternate feedstocks. You mentioned green chemicals. There's lots of green chemicals, but they are very niche and relatively small volume and a very tiny sliver of the supply pie right now. But, come and learn the prospects for all those areas of the industry. There's specialty chemical stream as well, actually.
Yeah, I will say one of the things I've always loved about attending WPC, and I've been able to attend on and off through the years, is it is one spot to get a lot of in-depth information. And frankly, I'm not sure if I should admit this to you guys or not, but as a small business owner, or sometimes even in a big business, we couldn't necessarily afford to pay for the big programs that you guys produce in terms of all the analytics and the data and subscribing. And so attending WPC is great value because the amount of information that is shared that you can take and directly apply to your business and look like the smartest person in the room because you know what's going on. Awesome.
What better endorsement? Thank you.
Absolutely.
But it's great networking opportunity as well. You come and you meet your industry peers, very social events in terms of receptions and things like that as well. But people from all over the world. It is a world petrochemical conference. We've got people from all continents.
So I'm going to wrap up the formal part of this interview, and then we're going to move to questions. But I want to ask Kurt and Tony, if there was one thing that you would advise a chemical leader, a strategist, a business leader to be monitoring in 2025 to be ready to take action in their business, what would it be?
I think for chemicals, look, downturns are just good for pruning, as you said earlier on, right? It is the opportunity to make your organization that little bit leaner. We all need to shed costs. It doesn't matter what the industry is, but becoming lean is also about becoming fit for future growth. And, this is a long downturn. We had a long upturn in the, 2010 to 2020. We had people were talking about a super cycle. We had a long period of profitability. That's soon forgotten, right? We're struggling now and it's a long downturn, but it will come to an end, right? And then the industry does need to invest to grow. So it's about getting your organization fit for that growth. And you need to be studying your investment options now to start up in the early 2030s. And it doesn't matter who the president of the United States is, right? You're going to build a refinery, an energy plant, or whatever to last 40 years, maybe 50 years. It's going to see a few presidents, right? So don't worry about who's in power.
Yeah, love it. Thank you.
No, I'd say
Kurt.
keep that long view, right? I think we are oil demand will peak, plateau, and then I think we could all debate kind of when and how quickly. So I think the whole feedstock, keeping that feedstock view over the long term, and I think the cold climate sustainability will continue as well. Different paces, different markets, right? So don't get too balled up. Don't get too frozen, right? We're going into a period of high uncertainty, like we talked about, but that doesn't mean you shouldn't be making business decisions and keeping kind of that long view across. Political systems will shift, right? And we'll be here 5-10 years ago talking about a shift of that pendulum back the other way.
Awesome. All right. Well, Tony and Kurt, this has been excellent. Thank you. I really appreciate your time today, and I appreciate everyone joining us. Thanks for joining us today on The Chemical Show. If you enjoyed this episode, be sure to subscribe, leave a review, and most importantly, share it with your friends and colleagues. For more insights, visit thechemicalshow.com and connect with us on LinkedIn. You can find me at Victoria King Meyer on LinkedIn, and you can also find us at the Chemical Show podcast. Join us next time for more conversations and strategies shaping the future of the industry. We'll see you soon.